You've probably been taught that SMT divergence is the holy grail. You see ES make a higher high, NQ makes a lower high. You hit the sell button and you get completely run over. Why does this happen? Because SMT by itself is not a reversal signal. Today is the SMT Masterclass. I'm going to show you exactly why most retail traders lose money using SMT, how to filter out the noise using a higher time frame narrative, and the exact fractal checklist you need to ensure you are trading a high probability setup, not a trap. Let's do a quick 30-second recap. SMT is simply a divergence between heavily correlated assets. Usually the S&P 500 and the Nasdaq move in lockstep. When they don't, when one takes out a high and the other fails to do so, it shows us underlying weakness or strength. So, what is the trap? The trap is trading SMT in a vacuum. Most traders see SMT form in the middle of nowhere and assume the market is reversing. But here's the golden rule. Price is always seeking liquidity. It is either moving toward internal range liquidity, like a fair value gap, or external range liquidity, like major swing highs or lows. If the higher time frame draw on liquidity has not been met yet, any SMT you see is just a speed bump. It's institutional manipulation, not a reversal. If you short that SMT, you become the liquidity. To avoid the trap, we have to frame the market using narrative and session timing. Think of the market like a GPS. The GPS has a destination. That is your draw on liquidity. Let's say the 4-hour chart is pushing down toward a massive pool of liquidity below an old low. During the morning session, as price pushes down on the 15-minute chart, NQ might start lagging behind ES, and SMT forms. Retail traders go long. But what happens? The market pauses, grabs their stop losses, and aggressively pushes lower to hit that 4-hour target. The manipulation phase wasn't over. Rule number 1, never trade SMT against the true draw on liquidity. SMT is only valid when it forms at the destination. We want to see price tap into our major liquidity pool or order block first. If we haven't reached the destination, ignore the divergence. Now we know where to look for SMT at our higher time frame target. But when do we actually enter? This is where we drop down to the lower time frames and use a specific fractal sequence for pinpoint precision. The model requires 3 specific steps. Candle 1, the manipulation candle. This is the candle that sweeps liquidity or taps into our higher time frame zone. Candle 2, the reversal candle. It must fail to hold the direction of candle 1 and close aggressively back the other way. Here's the secret sauce. The SMT must happen on candle 1. While ES is printing candle 1 and sweeping that major high, NQ should be failing to sweep its high. This confirms that the sweep on ES is a pure liquidity grab, engineered by smart money. But we still don't enter blindly. We wait for candle 2 to close. That candle 2 closure, combined with heavy displacement, is your ultimate confirmation. SMT was the warning sign. The fractal reversal is the green light. Let's look at a real breakdown from start to finish. We are doing a full top-down analysis here, starting from the daily chart all the way down to the 3-minute execution. Forget the theory. This is what actually pays you. Everything starts with the higher time frame narrative. Look at this daily chart on the Nasdaq. At the lows, we have a clear SMT divergence, But more importantly, look at the candle action. We get a perfect C2 closure, a daily reversal candle, closing aggressively bullish, confirming the divergence. With that daily closure locked in, our bias is set, and our draw on liquidity is clearly defined as the fair value gap resting above. Now we drop to the 4-hour chart to see how that daily structure was built. From the 13th to the 17th, you can see this massive, glaring SMT divergence forming. While other markets were breaking down, the Nasdaq held its ground, printing this beautiful ascending red line. Notice how the London session, marked at 2 a.m. and 6 a.m., accumulated positions and supported price. Smart money is heavily loading up on the long side. We have our daily and 4-hour narrative. Now we drop to the 30-minute chart to watch how the New York session engineers liquidity. Watch the session opens closely. We get the 8:30 a.m. open and price starts dropping. Then the 9:30 a.m. equities open hits and price aggressively drops again. Retail traders see this morning weakness, panic, and start shorting. But look at where that 9:30 drop stops. It violently rejects right above our higher time frame SMT line, creating a protected low. This entire morning drop was nothing but our manipulation phase, designed to trap early shorts and grab liquidity before the real move. The trap is set. The manipulation is over. Now we drop down to the 3-minute chart for the execution. Immediately after that 9:30 a.m. manipulation drop, look at what price does. It violently rejects that protected low and prints massive, energetic, bullish candles. That is our lower time frame reversal. It displaces higher, breaking short-term structure and giving us a crystal clear change in state of delivery. We don't chase. We wait for the setup to come to us. Look at the execution. Right here on the chart, we enter on the retracement back into that 3-minute displacement. We tuck our stop loss safely below that 9:30 a.m. protected low. Because if the narrative is right, that low should never be traded through again. We target the external buy side liquidity above. The market instantly expands to the upside, delivering a perfect stress-free trade. Daily reversal, 4-hour accumulation, 30-minute manipulation, 3-minute execution, pure mechanics, zero guessing. SMT is a powerful tool, but it is just one piece of the puzzle. When you combine the structural narrative of the higher time frames with the mechanical entry rules of a fractal model, you stop guessing and start trading with true edge. Trade safe, and I'll see you in the next video.